American Express was the Dow's biggest riser yesterday after being upgraded to outperform by Keefe, Bryan and Woods. So shares are now up 70% for the year, but most analysts have been cautious on shares this year. In fact, they continue to be. Only 5 of 24 analysts surveyed by Bloomberg have a buy rating on the shares. But Piper Jaffray's Robert Napoli has been bullish on the stock through good times and bad. He's had a buy rating on the stock since January of 2004 and joins us now to tell us why he hasn't jumped off the bandwagon yet. Now, you've been bullish on American Express all along in the face of a lot of disagreement. Why do you think it's so resilient?
Well, I think that, first of all, things change rapidly in the fall. That was very hard to gauge. But I think, American Express got down to very depressed levels. The stock did. And I think people really underestimated the strength of the franchise. 80% of the revenue comes from fee income. It's not nearly as credit sensitive. People were trying to value it on tangible book value like a bank. This company in good times generates return on equity of over 30%. So we just think it was misread. We've covered the company a long time through a number of different recessions. The company has been resilient in the past, and we thought investors should stick with very strong franchises, and American Express is one of those.
And you covered it through September 11th, 2001. Were you impressed with its resiliency then?
Yes. I mean, the stock got crushed right after 9/11, and that was a very tough time for American Express. They have a lot of travel business, but the company proved a lot more resilient than investors thought then. The stock recovered very early in that recession and then went back to its old premium valuations. We think it's likely to do the same again this time.
So let me ask you about this. You were talking about credit sensitivity. Capital One, a much higher percentage of its revenue is credit sensitive. Does that make it very different from American Express?
Yes. American Express gets 80% of the revenue from fee income. Conversely, Capital One only gets about 20 to 30% of their revenue from fee income. So it is much more credit sensitive, which obviously going into an uncertain environment, you need to be more cautious on. Coming into a stronger economy, Capital One could benefit more than some other financials.
Do you think the ongoing battle between the government and credit card providers could maybe turn consumers off from purchasing on credit?
Well, first of all, most people that use credit cards don't borrow on credit cards, so they won't care very much about what's going on. The people that do borrow, there will be less people able to get credit card loans because of the legislation. So I do think that the credit card debt outstanding will shrink. But recall again that most people that use credit cards don't borrow. They pay it off each month. They earn the points. There's incentives. And I do think that incrementally there might be a little bit more spending on charge cards and debit cards than credit cards. But for the most part, the spending on credit cards won't be affected. The lending, the people who borrow, that will become a smaller pool as credit card companies are forced, essentially raise their standards given some of the restrictions that government is placing on them.
I want to bring in financials. They're up 123% from March lows. Do you think they're still undervalued?
Well, on average, in every company is a different situation. As we know, many companies went out of business last year. There are some franchises that are probably impaired, permanently impaired. But if you break down and you look at financial services on average relative to book value and relative to normalized earnings, they're still trading well below their historical average levels. So if you have a good financial company like an American Express trading at under 10 times earnings power when historically they've traded at 20 times normalized earnings, certainly on average, we still think that financials are undervalued. Assuming a gradual economic recovery, I think that financials will still outperform the market.
We know you're feeling good about American Express, but we want to hear about the rest of your top picks.
Well, we like Western Union trading at 10 times earnings. It has a double-digit free cash flow yield. It's a great franchise, super cash flow. They dominate the money transfer market. MasterCard and Visa. MasterCard trading, we think the estimates are way too low on MasterCard, trading at about 13 times our 2011 earnings estimate, below the S&P 500 with earnings double the growth rate of the S&P 500. We think that's a very good buy. Visa, a little bit more expensive, but a similar story. Neither MasterCard nor Visa have any debt on the balance sheet, so very safe balance sheets, very long-term secular growth
Okay, we've got to wrap you. So
internationally.
sorry, we're going to take a break, but thanks to Robert Napoli of Piper Jaffray, who's feeling very good about the credit card companies.